Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, February the 28th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement in your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Quite a bit of economic data today, especially here in the United States. Across the pond, we had the French consumer spending came in line with expectations at 0.6%, was expected to be 0.6%. We also got the French preliminary CPI, Consumer Price Index, came in slightly lower than expected at 0.1 versus the expected 0.4. And then we also got the French preliminary GDP numbers, gross domestic product, right in line with expectations at 0.4%, where it was expected. And then we also got Italian preliminary CPI, came in slightly higher than expected at 0.3% versus the 0.1%. And then here in the United States, we got our own economic data in the form of GDP. We got GDP coming in at 1.9%, was expected to be 2.1%, so lower than expected there, so not really showing any sign of robustness for that matter. And then we also got good trade balance came in at negative 69.2 billion versus expected negative 66 billion. That's really not a very widely looked at number. We also got the wholesale inventories number came in at negative 0.1, expected to be a build of 0.5%, so better than expected there. Retailers or wholesale manufacturers ended up moving more inventory. Doesn't really say whether or not they are producing more, but they are moving inventory, lowering overall margins. Then the Chicago PMI came in at 57.4, was expected to be 53.4, higher than expected there. A lot of these numbers we're starting to see, like with the Richmond Manufacturing Index coming in at 17 versus expected 10, higher than expected there as well. So starting to look like the economy is really starting to move along here. We also got consumer confidence coming in at 114.8 versus the expected 111.3. So consumers looking to be pretty confident. And then we also have some Japanese manufacturing PMI data coming out and China's PMI data coming out later on this evening. And then again, we have President Trump speaking this evening at 9 p.m. On to the overall markets. We've got crude oil right now down 75 cents on the day. Really hasn't even been above water very much at all, except for maybe on the open. But now we're starting to come back down. We've been above that value area high. It's really testing that right now. As you can see here, it's kind of being repelled a little bit. We bounced off those lows, but really building up value here. We could, if we stay here much longer in this sideways moving market, we could easily see this point of control move right up here where the value area high is, and it's going to be very tight. So keep that in mind. We talked about all the oil out there and U.S. producing and exporting now a lot of oil. So there's just a glut of oil out there. It's not a surprise to me to see that market coming off. It's also helping accelerate some of the downside in equities as of the last hour or so. So last 45 minutes, I'd say. Then we got gold futures down just slightly again today. Yesterday, big sell-off late in the day. It looked like it was going to be pushing up, but late day sell-off as we saw in the equities as well. But the gold futures down or just off by about $1.50 right now. This is the bonds. Bonds cruising higher as the overall equities are sliding. This 50-day moving average is acting as resistance as it should. It's kind of pushing up against that. I really don't see us breaking out much of this range at all. The overall Fed governors speaking are just really saying that they could easily see interest rates, at 2% by the end of next year, or above 2% by the end of next year. It wouldn't be that detrimental to the economy from their standpoint. Then we got the Dow Jones down about 37 points. Actually, before this sell-off that I've been talking about in the last half an hour or so, the Dow Jones Industrial Average, Dow Jones Industrial Average had the tightest trading range that it's seen since like 2013. So it's been quite a long time. It's really just kind of been a quiet day. That's why I'm getting this out a little bit late. Really difficult to find anything to really do. I did end up finding a couple of things that I'll share here in a second. The NASDAQ leading the way to the downside, down about 22 points. This is in terms of percentage points, but down just slightly less than 0.5% at that point. Then we got the E-mini S&Ps down 7 points again. All of this really happening within the last half an hour or so. This is the chart. You can see we were really trading in a range. It was really looking like almost an inside day for the most part. And then the overall market just broke down. We're starting to see about a bit of a bounce here as there's some profit taking going on. But that was the real big sell-off. You can see it basically sold off from 65 to, 55, let's call it 57. So close to a 10-point sell-off in a matter of a half an hour. That's pretty decent move for the most part. Then on to XRT. This is a trade that I put on today. So I wanted to add something. XRT is an ETF. It actually has implied volatility above 50%. Right now, I think it's trading somewhere around 60%. So I decided to build a strategy around this one, take advantage of some of that high implied volatility. If I can see a little bit more of a pull off. I actually looked at doing this the other day when we saw the real high implied volatility, but I thought I missed it. Seeing a little bit of a bounce here in implied volatility, so I decided to take advantage of that, try to build a strategy around it. I'm not sure that I'm really sold on the retailers right now, so I am a little bit concerned with the downside, but I think that if it comes down here and tests this value area low, it'll hold at least for a little while. So I was able with this high implied volatility to get way down here and create an iron condor with this. So I went into the April and did the 39, 40, 45, 46 iron condor in there. So I'm basically short the 40, 46 strangle in there, and then define the risk at the 40, I'm short the 40, 45 strangle, and then define the risk by buying the 46 calls and buying the 39 puts. So that's what creates that iron condor. Pretty much in line with my rules for this. When you get the big volatility expansion, try and collect about a third the width of the strikes, and I was able to sell it for 36 cents, so it's slightly better than that. I actually looked at stretching out those, making it a $2 wide iron condor. We're defining the risk $2 wide, but it wasn't giving me enough premium to kind of make up for the difference. So I decided to go with the $1 wide iron condor, make it a third the width of the strike, and follow right along with my rules for that strategy. So you can find that at protraderstrategy.com if you want to go and check that out. The other trade that I just got before we went on here was BMI, Bristol Myers. If you remember, I took advantage of this high implied volatility. It really spiked. So I think it was like on the 16th of February, I decided when we got this sell-off that it looked like it was going to, it was a half-back day on that candle. I thought it was going to be pretty bearish, so I decided to go in and sell some calls in there. And I did it in the March, sold the 60 calls for 63 cents, if you remember. Was able, because of that high implied volatility, you guys, which is what I talk about so much. I love high implied volatility because you can be directionally wrong and still make money. So with this, I was directionally wrong, but we had high implied volatility, and that came out, as you can see here on the chart. Implied volatility just continued to come out of that. Despite the fact that it was rallying against me, I was short those calls, sold them for 63 cents, was able to buy them back for 32 cents today. Got that on this sell-off in the equities that kind of pulled those down too. So that was a nice little trade there. I was able to get way up here in the 60s when I had that high implied volatility. So it was a lot of room for error on that. Plus, I figured that it would kind of want to stall out at this point of control, which is where the most time and volume's been spent. It's where the market's really comfortable, so I thought it would kind of settle down there, and we'd see that. That's exactly what happened. If I got the sell-off, I was good. If it kind of rallied up and hit that point, then I was also looking pretty good. But the big thing about this is that implied volatility coming out. Was able to take advantage of that. All right, so that's all I got for you guys today. Other than if you can't take that, take it easy.